Choosing the right legal structure can significantly impact your financial well-being, especially when it comes to taxes. Many savvy entrepreneurs are turning to S corporations or S Corp to unlock tax benefits while maintaining a straightforward business setup. An S Corp is a special tax designation granted by the IRS that allows small businesses to avoid double taxation. Unlike C Corp, S Corp are pass-through entities, meaning profits and losses are reported on individual tax returns. This structure eliminates double taxation, making S Corp attractive for small business owners. In the following sections, we'll delve deeper into the specific tax advantages of S Corp and explore how they stack up against other common business structures. One of the most significant advantages of forming an S Corp is the potential to reduce self-employment taxes. In a sole proprietorship, owners pay self-employment taxes on all profits. S Corp, however, allow profits to be distributed as dividends, not subject to self-employment taxes. This can lead to substantial tax savings. Consulting with a tax professional ensures compliance and maximizes benefits. By strategically planning, S Corp owners can optimize their tax strategy. At the heart of the S Corp's tax advantages lies the concept of pass-through taxation, a mechanism that sets it apart from traditional C corporations. In essence, pass-through taxation means that the S Corp itself does not pay corporate income tax on its profits. Instead, these profits and losses flow through the business to the individual shareholders' personal income tax returns. This eliminates the dreaded double taxation scenario often associated with C Corp, where profits are taxed once at the corporate level and again at the individual level when distributed as dividends. Imagine a group of entrepreneurs who have joined forces to establish an innovative tech startup, structured as an S Corp. Thanks to the pass-through taxation structure of the S Corp, this profit is not taxed at the corporate level. Instead, it is allocated to each shareholder based on their ownership percentage. Each shareholder then reports their respective share of the profit on their individual income tax return. The beauty of pass-through taxation lies in its simplicity and potential for tax savings. By avoiding the corporate tax rate, S Corp shareholders can often retain a larger portion of their business profits. This can be particularly advantageous for small business owners who are actively reinvesting profits back into their businesses for growth and expansion. Furthermore, pass-through taxation simplifies the tax filing process for S Corp. However, it's essential to remember that while the S Corp itself doesn't pay corporate income tax, shareholders are still responsible for paying taxes on their share of the profits at their individual income tax rates. These rates vary based on factors like income level, filing status, and applicable deductions and credits. Therefore, it's crucial for S Corp shareholders to engage in meticulous tax planning and consult with qualified tax advisors to optimize their tax liabilities and ensure compliance with all IRS regulations related to pass-through taxation. One of the most compelling advantages of S Corp lies in their potential to reduce self-employment tax liabilities for business owners. Self-employment taxes, which encompass Social Security and Medicare contributions, can significantly impact the overall tax burden of individuals operating as sole proprietorships or partnerships. However, S Corp offer a unique opportunity to potentially lower these taxes through a strategic approach to income allocation. In an S Corp, shareholders who actively participate in the business are considered employees and are required to receive a reasonable salary subject to payroll taxes, including Social Security and Medicare. However, any remaining business profits distributed to shareholders as dividends are not subject to self-employment taxes. This distinction between salary and dividends forms the basis for potential self-employment tax savings with S Corp. By strategically setting their salaries at a reasonable level and distributing a portion of the profits as dividends, S Corp owners can effectively reduce the amount of their income subject to self-employment taxes. However, it's crucial to strike a balance and ensure that the salary paid is justifiable based on industry standards, job responsibilities, and the overall financial performance of the business. The IRS closely scrutinizes salary levels to prevent business owners from disguising what should be considered wages as dividends to avoid payroll taxes. Consulting with a qualified tax professional is paramount when determining a reasonable salary for S Corp owners. They can provide valuable insights into industry benchmarks, IRS guidelines, and potential red flags to avoid during audits. By carefully navigating the intricacies of self-employment tax regulations and adopting a strategic approach to income allocation, S Corp owners can potentially achieve significant tax savings while remaining compliant with all applicable tax laws. Section 3. The allure of qualified business income deduction, amplifying S Corp benefits. The Tax Cuts and Jobs Act of 2017 introduced a game-changing provision for pass-through entities like S Corp, the Qualified Business Income, or QBI deduction. This deduction allows eligible taxpayers to deduct up to 20% of their qualified business income, further enhancing the tax advantages of operating as an S Corp. The QBI deduction is a significant boon for small business owners, offering the potential for substantial tax savings and increased cash flow. To illustrate the power of the QBI deduction, consider a married couple who own and operate a successful marketing agency structured as an S Corp. Their business generates $200,000 in qualified business income for the year. Under the QBI deduction, they may be eligible to deduct up to $40,000, which is 20% of $200,000 from their taxable income. This deduction directly reduces their tax liability, potentially saving them thousands of dollars. However, it's important to note that the QBI deduction is subject to certain limitations and phase-outs based on the taxpayer's taxable income and the type of business. For example, there are specific rules and limitations for specified service trades or businesses, such as those involving the performance of services in fields like health, law, accounting, consulting, and financial services. Navigating the complexities of the QBI deduction requires careful consideration of various factors and adherence to IRS guidelines. It's highly recommended to consult with a tax professional to determine eligibility, calculate the deduction accurately, and ensure compliance with all applicable regulations. By taking advantage of the QBI deduction, S Corp owners can further amplify their tax savings and optimize their financial outcomes. Section 1. S Corp versus sole proprietorships, weighing the pros and cons. Entrepreneurs must choose the right legal structure for their business. Sole proprietorships are simple but expose owners to personal liability. S Corp offer liability protection and tax advantages. They allow for pass-through taxation and potential tax savings. Consulting a tax advisor can help determine the best structure. Section 2. S Corp versus partnerships, a comparative analysis of tax implications. When multiple individuals join forces to launch a business venture, partnerships often emerge as a viable structure. However, as the business landscape evolves and tax implications come into focus, entrepreneurs may find themselves contemplating the merits of an S Corp as a compelling alternative. Both partnerships and S Corp share the characteristic of pass-through taxation, but subtle differences in their tax treatments warrant careful consideration when choosing the most advantageous structure for a multi-owner business. In a general partnership, each partner reports their share of the business profits and losses on their personal income tax returns, regardless of whether they received any actual distributions from the partnership. This can lead to a situation where a partner is liable for taxes on profits they haven't actually received, potentially creating financial strain. S Corp, on the other hand, offer more flexibility in this regard. While shareholders who actively participate in the business are considered employees and receive a salary, dividend distributions are typically made based on ownership percentage. Another key distinction lies in the treatment of self-employment taxes. As with sole proprietorships, general partners are subject to self-employment taxes on their share of the partnership's profits. S Corp owners, however, can potentially reduce their self-employment tax liability by strategically allocating income between salary and dividends. This distinction can result in significant tax savings, especially as the business becomes more profitable. Choosing between an S Corp and a partnership requires a thorough assessment of the business's long-term goals, the number of owners involved, and the desired level of liability protection. S Corp, with their potential for self-employment tax savings and the separation of personal and business liabilities, often emerge as the more tax-efficient and liability-protective option. However, seeking guidance from a qualified tax professional is crucial in navigating the complexities of each structure and making an informed decision that aligns with the unique circumstances of the business and its owners. Entrepreneurs face a choice: S Corp or C Corp. C Corp are subject to double taxation, corporate income tax and individual tax on dividends. S Corp avoid this with pass-through taxation, taxing profits only at the individual level. This makes S Corp more tax-efficient for businesses distributing profits to owners. C Corp offer benefits like deducting fringe benefits and more flexibility in expenses. Consulting a tax professional is crucial to determine the best structure for your business. Real-world examples highlight S Corp tax advantages. Consider a small accounting firm as an S Corp with £150,000 profit. Profits pass through to partners' personal tax returns, avoiding corporate tax. As a C Corp, the firm would pay £31,500 in corporate taxes, plus individual taxes on dividends. Total tax liability as a C Corp, £49,275. As an S Corp, partners only pay personal income tax, retaining more profit. E-commerce businesses can benefit from S Corp status. A handmade jewelry business transitioned from sole proprietorship to S Corp. This move reduced self-employment taxes by allocating income as dividends. The owner paid a reasonable salary and distributed remaining profits as dividends. This resulted in substantial tax savings and liability protection. The S Corp structure fueled business growth and protected personal assets. Strategic tax planning is key for S Corp owners. Determining a reasonable salary for shareholder employees is crucial. The IRS scrutinizes salary levels to prevent tax avoidance. Consulting a tax professional ensures compliance and optimizes deductions. S Corp can deduct business expenses and fringe benefits. Staying informed about tax law changes is essential for maximizing benefits. Establishing an S Corp requires meeting IRS criteria. Ensure your business is eligible domestic corporation, allowable shareholders, one class of stock. File articles of incorporation with the state. Obtain an employer identification number, EIN, from the IRS. File Form 2553 to elect S Corp status. This step-by-step approach ensures a smooth transition to S Corp. Understanding IRS forms and deadlines is crucial. File Form 2553 within 2 months and 15 days of the tax year start. Missing this deadline means higher tax liabilities as a C Corp. File annual tax returns using Form 1120S by the 15th day of the 3rd month after the tax year ends. Comply with state-specific filing requirements. Proper filing ensures compliance and maximizes S Corp benefits. Ongoing diligence is required to maintain S Corp status. Ensure your corporation meets eligibility requirements. Regularly review shareholder structure and share agreements. Maintain detailed financial records and hold regular meetings. Document key decisions and actions taken by the corporation. Compliance ensures long-term tax advantages and liability protection. Avoid common S Corp pitfalls with expert guidance. Consult tax advisors and attorneys during formation and management. Establish reasonable salaries for shareholder employees to avoid IRS scrutiny. Maintain adequate documentation and record-keeping practices. Stay informed about changes in tax laws and regulations. Proactive planning and compliance maximize S Corp benefits. Navigating business structures and tax regulations can be daunting for any entrepreneur. Understanding S corporations, S Corp, empowers business owners to make informed decisions for financial success. S Corp optimize tax liabilities, safeguard personal assets, and foster a thriving business environment. They reduce self-employment taxes, offering a strategic advantage over sole proprietorships and partnerships. By allocating income between salaries and dividends, S Corp owners can lower tax obligations. Liability protection shields personal assets from business debts and lawsuits. Pass-through taxation eliminates double taxation, simplifying accounting and saving taxes. Seek guidance from professionals to maximize S Corp benefits and ensure compliance.